What is good, fellas? Today we are on day 4 of the vol. We've so far gone over candlesticks and market structure, and that means we are now on liquidity. So, if you have ever wondered why price spikes randomly, sweeps highs, takes out lows, and you might not even know what sweep is or taking out a high means, but we're gonna get into that. Liquidity is basically the engine behind all price movement. It's not indicators, it's not luck, it's not manipulation for no reason. Price moves towards liquidity, and liquidity being, well, money. And it's always going to move towards money. It's simply put where other traders' money is. And that includes stop losses, pending orders, liquidation, breakout orders, people buying in high, selling in low, retail traders placing tight stop losses. It's wherever there's clusters of orders, and that's where the liquidity sits. And what does these market makers and algorithms and big money want? Well, they want to access those orders because that's how they fuel their big moves. Alright, so first off, what is liquidity? Well, liquidity is, like I explained yesterday, if you remember, a swing high or a swing low. That's essentially what a liquidity pool would look like. It's basically like this or like this. That's usually what a liquidity point will look like. So this would be liquidity, this would be liquidity, this would be liquidity, this would be liquidity. All price points where price would want to draw towards naturally, as there's a lot of money sitting above those highs. Same thing the other way around, being these lows, these lows, these lows, these lows. Like, these are all swing points that would count as valid liquidity. And when we're talking about liquidity, we want to see strong rejection points, because that's usually where these other traders would look for entries. So stuff like this would be a good liquidity pool. 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 Like all these highs where there is strong rejection from something. Like for example here we are rejecting from a fair value gap, which is a coming video. This has clearly rejected from something. So if we were to go down and take out this low, we were most likely to go up from here. This is a nice low to take, especially considering we are flipping into a bullish trend. Now, when speaking about liquidity, we have many different liquidity pools, being, for example, I'm just going to mark out every single one. We have equal highs and equal lows. We have low resistance liquidity. We have, like I explained, just regular sell side and buy side liquidity. We have previous, which can be a previous day, previous month, previous year, previous week. It can be everything. So I'm just going to say PXL/PXH. And other than this, we also have internal liquidity, which would be these other confluences that I'm going to teach you guys about in future videos, like fair value gap, order blocks. All that good stuff would count as, well, internal liquidity. These are more so external liquidity, like clear swing points. Now, let's go over them. So what is an equal high or an equal low? Well, it's kind of in the name. It's highs, like swing points, like we talked about yesterday, that are equal, that hasn't swept out each other. A sweep meaning something that would probably look like this. Like we have a market structure where we have a higher high, like I talked about yesterday, and we take out this high without closing above it, and then go down. This would count as a liquidity sweep. If we just wick up and close below it again, that's what we would like to call a liquidity sweep. Now, equal highs or equal lows would mean that we have a higher high and then a lower high after, or some sort of move down and then a move up where we don't take out this high again. And these highs would now be equal. Retail traders would look at this and see a double top and then look for shorts and then have their stop losses above this high, meaning there's a lot of money above these highs, making it a prominent liquidity pool where the market makers would like to draw price towards. Same thing being the other way around. For equal lows, it would just look something like, well, this, where we have these equal lows. Now, liquidity sweeps doesn't always mean a reversal. It can sometimes mean that we have, like for example, these equal highs. I wouldn't really count these as a liquidity pool that we would reject from. I would rather count this as a draw on liquidity, aka where I would want price to go towards now that we have flipped into a bullish trend. So if you remember yesterday's video, we have been in a bearish trend for, well, ages now. And price action on the lower time frames, like the 4 hour, the 1 hour, has just started flipping to the bullish side. Meaning we can start to look for longs. And when we look for longs, we don't want to see shorts play out from this liquidity pool. We want to use this as a magnet for price to go towards to continue the bullish trend. And same thing being, for example, these highs right here, where we have all these equal highs just stacking on top of each other. I want to see price go towards these highs next. Something else I also remember that we have a prominent liquidity pool is, well, session liquidity. Something that we will also go over. That means like highs and lows that were made during, for example, Asia session, or highs and low that was made during London session or New York session and all that stuff. But first, what is low resistance liquidity? What does this look like? Low resistance liquidity will mean something like we are, for example, let's say we are in a bearish trend. That will look something like this, right? Now, low resistance liquidity means that we have been in a bearish trend for very long without taking any prominent liquidity, leaving all of these highs behind. Now, I like to call this low resistance liquidity. Some people like to call it trendline liquidity because we're following a trend line. But trend lines do not hold because they're fucking magical, all right? Trend lines hold because retail traders pile into trend lines, which means their stops build up on the other side. So when prices top the fucking trend line like 3 or 4 times, that would be a liquidity pool. And these trend line breaks aren't random. They're liquidity grabs. So for example, let's say we have left behind all of this stacked liquidity and we come into a key level of support or a key level of resistance if this is flipped, like here. This is super nice draws on liquidity that we can use. And moves like this usually happen really fast and really volatile. So you will usually see candles like this just taking out all of these stop loss orders the moment we have rejected from some sort of key point of liquidity or support. Examples of low resistance liquidity could be something like this right here. You see that we have stacked equal highs and we haven't really taken out any sort of liquidity yet. So as you can see, we have bearish market structure where liquidity never gets taken. And then we have this candle, which just takes out everything in one single candle. This could also count as low resistance liquidity, as we have just left a lot of lows together. And you can see all of these lows were just taken out in an instant. Now, just because there is trendline liquidity or low resistance liquidity doesn't mean that price will instantly draw towards it. Like here you can see as well, on the higher time frame, we also have these this low resistance liquidity, and we just end up taking all of it in fucking 3 hours. Now you might also notice that on our current time frame, we have left behind all of this resting liquidity down here, and the trend is starting to flip bullish. Now what does that mean? It means we most likely are to run all of these highs in the next coming days or coming weeks. But yeah, that's basically just a really simple explanation of what low resistance liquidity can be used for. Now you're going to understand these liquidity pools way better once we get into strategy building and stuff like confluences. But for now, I just want you to remember how they look like and what they can be used for. Like for example, if we have all this resting liquidity like I was talking about, and we have a really nice setup forming down here, longs can be a really good option to take out all these highs, well, and beyond, like towards these highs. And same thing other way around, if you get a super nice short setup somewhere around here, well, you can get a really nice setup. Just remember what they look like. That's the main part of this video. Now, sell side and buy side liquidity, we just went over that. It's just clear swing points. Sell side being the bearish, being this, and buy side being this. You can look at it like buy side being the higher highs and sell side being the lower lows. Now, previous day, previous week, previous month can be found on the higher time frames like this. You just go on the monthly, for example, and you mark out the previous month low, which you can see that we have clearly rejected from. That was the low that we rejected from. Took out this liquidity, and flipped to a bullish trend. I'll just do this super simple. So this will be previous week high, this would be previous week low, this would be the previous week before that high, and that would be the previous week before that low, and so on. Same with month, this would be previous month high, this would be previous month's low, and this would be previous day high, this would be previous day low, and so on and so forth. So when traders talk about previous weekly high, previous daily low, previous month's high, they're referring to one thing, and that's the highest or the lowest point where price has reached during a specific time period. And that's where a ton of orders are sitting. These levels are incredibly fucking important because they act like magnets for price. Like previous day high, that's the highest price of yesterday's trading session. Previous day low, that's the lowest price of yesterday's session. And then we have the previous weekly high, which is the highest price market reached last week, and so on and so forth. And here's the truth. These levels work because they're massive liquidity pools. Think about it. Every retail trader, prop firm rule, algo, smart money model, mechanical system, swing trader all refer back to these major highs and lows. So naturally, there's a ton of stop losses, limit orders, breakout orders, pending buys and sells, liquidations packed around these prices, which means there's money sitting there and price will always go where the money is. Now, there's two different ways that I like to trade previous day, previous week, and all that kinds of levels. I already have a video on one of the ways I like to trade them, aka with deviations, which is something we're not going to get into quite yet, but will look something like this. Let's say this is the previous day high, right? Price likes sometimes to just go above and deviate above it to build liquidity. Building liquidity meaning they're trapping all of these retail traders who like to trade the breakout. They like to look for the bounce again off the previous day high to look for longs further up. But what these institutions like to do is deviate above these levels to fill big orders by trapping all these retail traders before they flip right back down below previous day high and continue lower. Now, another version of previous day high sweeps or previous day high or previous day low, whatever kinds of trades you can look for is, well, the classic previous day high sweep, which would just look like this. A failure to close above the previous day high and then a reversal. That's another classic. And then we also have the one I just talked about, which is if we're in a heavy bullish trend, you can just look for, well, the previous day high as a retest, a breakout, like this. And a retest and then continue higher. This is also a way previous day high can work. And this works on all the ones that I've mentioned, like previous day high, previous month high, previous week low, all the ones that you can expect. And the way to use them, well, is always to mark your previous day highs and lows, previous week highs and lows, and your previous month highs and lows. What I like to use for previous day high and low is this indicator right here. It's called FX4. It just marks out the previous day high and previous day lows for you. And since I am just an intraday trader, these are the levels that I use the most. I like to use the previous weeks and the previous months ones as well, but it's just that we don't really get that many trades off them that often. But it's just like any other liquidity pool. You never really enter directly off the level. You wait for confirmation or candle closes or structure breaks. And last but not least, we have session liquidity. For that, I like to use this indicator, Market Profile by Joshua, which shows you all the previous session highs and lows. Like you can, for example, see on Friday, we took out Asia lows right here, took it out, and then decided to reverse off it. You can also use these. It's basically used like any other liquidity pool. Session highs and lows is basically used like any other liquidity pool, like I've explained. It's just stronger points of liquidity as it's the highest point that happened during a session, which means there's a lot of orders sitting there. Like for example here, you can see that Asia high got taken out perfectly before a big reversal to the downside. Same thing, for example, yesterday, we took out Asia lows again and decided to reverse right off it. Now, I'm not saying that this will happen every single time that you take trades off these liquidity points, but that's why we have or make strategies and use confluences. We use them to find our entries to target, well, other points of liquidity. And yeah, that's basically it. It's just strong draws on liquidity if you have a bullish bias, or if you don't have a bullish bias but you have a bearish bias and we go up into, like, let's say this is session liquidity or this is some sort of liquidity that we talked about, but you have a bearish bias, then you're looking for a sweep of this and then a rejection, and then a confirmation entry, which is what we're going to get into in other videos. But yeah, there's obviously way more to this, like to liquidity, but we're going to get more in depth into how to use liquidity to build a strategy around it and how to find your entries when we get more in depth on the other concepts that we're going to teach, like weaker highs and lows from breaks of structure. We have consolidation range liquidity. We have a bunch of other smaller like liquidity that we don't really have to care about just yet, but it's more important that you get it when we talk about the other, well, points of liquidity. But yeah, last thing I want to go over is how liquidity and structure work together. I think I've already explained this in the video, but I'm just going to go over this one more time. So in short, market structure tells you the direction, aka bullish or bearish, but liquidity tells you the destination. The pattern is usually the trend leg forms, pullback creates internal liquidity, price sweeps the liquidity, and then price sweeps the liquidity, and then you see a change of character or a break of structure to confirm your direction, and then price moves away with momentum. And that will look something like this. You will see a high, and then a low, and then a high, and then a low, and then you will see a sweep of this high, for example, and then a change of character, and then a retest, and then we'll continue lower. So in short, liquidity is not a signal. It's more so information. You don't enter just because liquidity gets taken. A liquidity grab is not an entry trigger. It's more so a context or a clue that tells you, okay, now price has fuel to go lower or higher. And then you can start watching for the change of character, and then you can look for the confirmation, and now you can apply it to your system. Now, again, I want to go through some homework for you guys. So for today, I want you guys to pick any chart, go to any time frame, mark 50 different liquidity grabs, and then you mark out equal highs and lows, and then you mark out where stops are clustered, and then you mark out where price has swept them, and then you mark what happened after. And then you're going to do that for 2 to 3 days of data, and liquidity is going to become so fucking obvious to you. And that's going to be it for day 4. Hopefully you guys have understood at least a little bit of what liquidity means and how it works. Tomorrow we're going to get into something even more important, and that's risk management. I want to get really in depth on how risk management works before we get into concepts like fair value gaps and imbalances, and why, like price delivers, I want you guys to know what risk management really means. See you guys in day 5. Let's keep fucking building.